Hello and thank you for joining us for this Market Watch session to discuss the investment implications of the conflict in the Middle East. First of all, our thoughts and prayers are with those affected. We hope the current situation will be resolved speedily with minimal disruption and, of course, casualties across the region. So what does this mean for investors? Well, naturally, there's been a pickup in market volatility, although this has not been as significant as many feared, at least so far. Before the conflict began, I was starting to talk about the economic environment becoming more Goldilocks-like. Global growth was accelerating slightly and inflation was coming down in most parts of the world. And this was expected to lead to further rate cuts in the US, UK and some emerging markets. Add in the likelihood of strong earnings growth and signs that the equity market recovery was broadening both geographically and sectorally, and the outlook was relatively rosy. So does the situation in the Middle East change this? The key issue here is the impact on oil and gas prices. As we saw in 2022, higher oil and gas prices can undermine growth, put upward pressure on inflation, and if sustained, can make central banks' jobs much more difficult. A short-term spike is not that problematic. What would be more challenging would be a sustained and sizable increase. The Gulf countries account for around 20% of supply of both oil and gas. And the key is the ability of Gulf producers to connect to consumers, mainly in Asia. And this is where the Strait of Hormuz comes in. This is a narrow part of the sea which separates the partially closed Persian Gulf from the open seas of the Gulf of Oman, which is sandwiched between Oman and Iran. The ability to get supplies through this area is critical to keeping oil and gas prices capped. Meanwhile, we have also seen Iranian attacks on energy-producing infrastructure, which have impacted an oil refinery in Saudi Arabia and Qatar gas output. What seems likely is that this conflict will continue for some time, potentially weeks, and therefore the risk of further energy price spikes is very real. The US says it has a plan to keep the Strait of Hormuz open, but for now traffic has come to an almost standstill for fear of attacks on ships entering the strait. Our central scenario is that the conflict will be relatively short-lived, and as such, oil and gas prices will ultimately decline back to pre-conflict levels. Under this scenario, any dips in equity markets are likely to be short-lived as the focus returns to strong fundamentals that I mentioned earlier. Of course, we cannot rule out something more prolonged, but the midterm elections in the US mean that the US is clearly incentivized to control the situation, either through military might or negotiations. Against this backdrop, we would look for dips in US and Asia ex-Japan equity markets, as well as emerging market bonds, as a good opportunity to accelerate investments. Meanwhile, we see gold as being the best hedge in portfolios, especially given its strong structural support from central banks in the emerging market world. Thank you for joining us today. I hope this helps place the current situation in context and assists with your planning in the coming weeks. I look forward to catching up with you again soon. In the meantime, please take care.